I'm really handing over to Fiona Reynolds, who is the Chief Executive Officer at the Principles for Responsible Investment. Fiona has been with PRI since 2013. She came to that role after around 20 years in finance and pensions. PRI, I was making notes for this, and I think I must have looked at a bio maybe that was sort of a few months old, and it said that PRI had signatories, there were 2,000 signatories, and had $80 trillion worth of assets that they were responsible for. And we're now up to $2,590 trillion worth of assets. So yeah, it seems to be progressing really very rapidly. As well as looking after the PRI, Fiona is also on the board of UN Global Compact and the International Integrated Reporting Council, and is on the steering committee for Climate Action 100. So I think she's enormously well placed to make sort of really some of the opening comments today in terms of the context that we're all working. And many of the people in this room, had a look at the job titles, many of you are analysts and portfolio managers and not necessarily specialists in sustainable or responsible investment. Fiona and I were talking just before we started, and we're sort of saying that this is quite a different crowd from some of those that either maybe attend the PRI conference or the Responsible Investor conferences. So it's really great to see sort of a different swathe of people coming into and challenging and being interested in discourse on this subject. And actually my first question for Fiona is about the way that we're progressing from focusing, I think, on responsible investment, which to my mind is becoming more mainstream, which is where you take account of ESG factors and their potential impact on your investments, and moving towards sustainable investment, which inverts that and looks at the impact on your investment on sustainability. And I just wanted to get, Fiona, your views on where you think we are in that evolution from responsible investment to sustainable investment, and whether or not responsible investment genuinely is now mainstream.
Thanks, Will. Well, first of all, it's great to be here. And as you were saying, when I was looking around and talking to people outside, I only saw about 2 or 3 people that I actually knew, which I thought was a terrific thing. You can spend a lot of time in this space talking to people who are already converted and know a lot about responsible investment. So it's great to really talk to people who this might be something that's new to. It's also really important to us at the PRI that people in the investment space, particularly those who are analysts, understand responsible investment. That makes our job much, much easier. I think when we talk about sustainable finance, I think that to me, many more regulators, policymakers, investors, corporations around the world really understand that the future of finance is sustainable finance. And if we look at the largest 50 economies in the world at the moment, there are now more than 730 either regulations or soft codes that have some requirements or encouragements for factoring in sustainability issues. Most of those have happened since 2000. So a big change there. And I think if we look particularly in Europe, sustainability is being embedded throughout the whole of the finance system. I thought that it was interesting when last week when the new FRC stewardship code came out, and I thought that showed as well some of that evolution of thinking about responsible investment, because the stewardship code sets out really clear expectations about the integration of ESG factors by investors, both the investment management community, the asset owner community, and the service providers to both of those groups. It really calls out systemic risks, but particularly climate change. So it's not just looking at individual companies, but what are the big systemic issues that are affecting the world and therefore are going to affect the environment. It really encourages as well a beneficiary voice as well as a client voice, which I think is important, and more people in civil society are wanting a voice. But the reporting through the Stewardship Code, coming back to your point, is not just about your activities. Yeah. It's about what were the outcomes. What were the outcomes of what you did? Because we can all go through and tick a lot of boxes, but what does that actually mean in the real world? And that's certainly in the direction that we're heading. I mean, you need to have all the processes in place first. I think responsible investment was very focused on process in the early days. And it still is to some degree because you have to have processes. But you can have a lot of processes and you can tick those boxes, but it doesn't really mean much at the end of the day. So we need to start looking at what does this really translate into in the real world. Thinking about those systemic risks, thinking about society more holistically, and particularly the environment. I think that, the days of having to convince people about responsible investment, I hope, are completely over. There's enough academic evidence out there now that shows that, we're not talking about giving up returns. Yes, we're talking about long-term investment. We're not talking about short-term investment. But, and I think from the asset owner community, there's also a shift in thinking. I don't think we're quite there yet, but that as, I really come from the asset owner side of things. I've always worked on the pension fund side of things, that it's not enough as a pension fund for you to think about the person's returns that you are providing for them for their retirement. That's your job. That goes without saying. But you also need to think about the world into which they are going to retire. And I think it's clear, much clearer, that your fiduciary duty now needs to take those things into consideration. I think that's where the Stewardship Code is going. But when you talk about are we there, I don't think responsible investment is completely mainstream. I think it's talked about as a mainstream issue. But I think that there's a long way to go till it's
not
completely
practiced? Or?
Yeah.
Okay.
Yeah.
So what element of practice do you think is sort of absent or missing?
Well, I think real integration across all asset classes, deeply embedded. Particularly in the UK, I think a lot of people have started off thinking about responsible investment from a governance point of view and from a listed equities point of view. And while practice is definitely going into all of the asset classes, and certainly some of our signatories do this across all asset classes, I think, there's still a long way to go until we could say that it's completely embedded. So we need to move more away from listed equities into all of the other spaces with really good practice. It's happening, but it's not all the way there. And also when I talk about, that from our signatories' point of view, that they've got 90 trillion in assets under management, I can no way say that every one of those $90 trillion is invested in a sustainable way. That is our aim. I hope one day that I can say that, but I would probably, it's hard to measure, but I'd probably say that about half of that is. So still a long way to go.
Yeah. You reference the Stewardship Code and talk about the development of the regulatory context and so on. It's great that the Stewardship Code includes a lot more on sustainability and people's duties with respect to ESG, but actually it was sort of a bit of a struggle to get some of that content into the revised code. You also have a recent publication on the inevitable policy response, talking about the sorts of changes in policy and regulation that you would expect us to see. That looks sort of, it's a great report, and I recommend it very strongly to anybody who hasn't read it yet. It's sort of a great guide to how might policy develop and what might that mean for the investment world. But my challenge, I suppose, is you call it an inevitable policy response, but there's always the moment where policy meets politics. How inevitable it sort of looks like to me like a logical policy response, but there's been a very strong trend towards a more supportive policy context for responsible investment and sustainable investment. How confident are you that that will remain in place, or do you expect it to actually build?
Yeah. So just really quickly about the inevitable policy response, and you're probably right, maybe the name is a bit hopeful. So the inevitable policy response is basically a thesis that we did 12 months ago, but we've done some other work since then, that basically says that there is no way that we can stay on the trajectory that we are, because we are nowhere near keeping the world to 1.5 degrees. At the moment, we're much more headed to 3.5 plus degrees. That there's pressure on governments from all around, particularly from civil society, and that they are going to have to ratchet up their policy responses. That they're leaving it too long, and therefore, because the longer you delay it, the more forceful the responses that you are going to bring in are going to have to be. And what happens, I'm not sure if everyone's familiar about the Paris Agreement, but the Paris Agreement that everyone signed in 2015 has got a ratchet up in it. So in 2023, there's a global stocktake that takes place. So it looks at what all the countries in the world are doing. And then in 2025, the countries need to put in another lot of commitments. It'll be clear then that we're so far behind that governments are going to have to do a lot more. And so our paper really talks about the 8 sort of key policy areas that we think that the government will use levers. So that's, around coal phase out, it's around banning of petrol and diesel cars, more meaningful carbon pricing, an end to deforestation, more reforestation, things like this. And what we're about to put out is also some economic modelling, some forecast scenario planning that investors can basically be able to use this information to look at their portfolios and say, well, what would this mean? How could I play around with this and say, if this policy happened to my portfolio, what would it mean? But we really think that investors are not pricing in policy risk at all. Most investors are using the IEA policy scenarios, but those policy scenarios only look at policy as it is today, and policy cannot stay as it is today if we're going to get to 1.5 degrees. And again, much more pressure on politicians to make sure that we get there as well. Although I do have to say, in talking about that in all of the modelling that we've done in this work, and it's very detailed, we've worked with a whole lot of economists, we can't work out how you get to 1.5 degrees without negative emissions technology that doesn't currently exist. So from the investment point of view, we need to be thinking about emissions reductions, etc. in our portfolio, but we also need the finance community to step up in terms of new technologies that are going to be the technologies of the future.
And you need policy to change and change more rapidly than it already is, and yet we saw with the development of the taxonomy that there was a lot of pushback as soon as people felt that there was real domestic pain that they might feel as a government, and how are we going to get through that in a much bigger way in the future?
Well, that's one of the biggest problems. One of the things that I've been focusing on a lot on at the moment is the climate lobby. So the climate denying lobby, not the climate positive lobby. And it's a huge lobbying force. The reason that we are where we are on climate change and that we aren't further than what we are is that there is a whole lot of people who don't want to see a change, particularly in the mining sector, in the energy sector, in big business. And they're winning the day. We are not winning the day, those who are trying to get more done about climate change. And I think it's an area that we, as an investment community, really need to tackle. At the end of the day, we have people who are using our money. We are the ones invested in the company. They're using it in a way that is not in our interest. It's not in our interest not to have climate change dealt with, because it will impact all of our investments. It cannot not impact us. But we do really think that governments will ratchet up. They should have been doing it a long time ago. It's getting really late, and that's why we think that the things that they will do will have a big impact on markets.
Yeah. In a moment, I'm going to sort of come to you with a sort of question around sort of clients, but I just do want to encourage you to ask questions yourselves. So far, I don't think I've got anything in the activity stream which is not exactly the response I was looking for from my earlier call for deep levels of engagement and lots and lots of questions.
Yeah, come on.
So this is fast-moving field. If there's anything that you're not sure about, Fiona is the right person to ask it of. So do please send in some questions. But you were talking there about sort of, we're the audience that can make this change. A lot of people in this room are going to work for investment management firms who see themselves as agents.
Yeah.
And so are waiting for instructions from clients. And it does seem to me as though a lot of policy at the moment has been focused very much on getting asset owners to take the lead in this field. Do you think that they've done as much as they can, or do you think we're going to go on loading more and more requirements onto asset owners for them to push down onto investment managers, for then the investment managers to sort of to put into valuations and the availability of capital for different kinds of sectors and different kinds of activities?
Well, asset owners are absolutely key.
Yeah.
They're a core part of the PRI. We started the PRI with asset owners. We would be nowhere near where we are with responsible investment without the asset owner community, because they are the long-term investors. You know, if I'm sitting around the table with CalPERS, for example, they manage liabilities for nearly 100 years, because they think about, if I closed this fund tomorrow, how long are my liabilities for? 100 years I'm going to be paying out money. So they are the ones who have really driven responsible investment. That doesn't mean we're all the way where we need to go. I think in the UK, I find it more problematic. I'm sorry, but I don't think the UK has a great pension system to drive responsible investment forward.
Too fragmented?
It's too fragmented, there's too many small funds, etc. Where you look around the world, who are the best at integrating ESG and sustainability factors? It's where you've had consolidated pension funds, where you've got very big, massive funds. So, you know, the Dutch, the Norwegians, all of the Scandinavian countries, you know, the Swedish, the Danish, the Australian, the Canadians, etc. Because once you've got that scale, you're really thinking about liabilities in a longer way. So I think that whenever I speak to regulators or policymakers in the UK, and they say to me, because I'm Australian, you know, well, the Australian system does a lot of investing in infrastructure and they do this and they do that. Why can't we do this? And I always say, because you don't have the scale, you need consolidation. And this, I come back to a frustration then when people say, oh, well, it's very difficult for asset owners because they don't have a lot of time and they are very busy and they only meet here. Well, that's not good enough to me. If people are managing my money, they need to be managing it properly. And if you can't do this, basically if you can't take the heat, get out of the kitchen and let someone else do it. But we have to have that. We have to have asset owners putting pressure on managers. That managers didn't come to responsible investment by themselves. They came at it because of asset owners. We spend a lot of time focusing our work on selection, appointment and monitoring of managers for asset owners, because that is really key. That when you select managers, that you understand what their ESG what their ESG capabilities are. But then it's not just enough to go, oh well, do you do some ESG? You need to then really be embedding it in contracts. We need asset owners to also be thinking about this from then the monitoring, because again, if you employ a manager but then you never actually ask any questions about how they did it or monitor or pay them any money for these things, then what are you going to expect? I think this is getting better, and it's getting better across asset classes, but I think asset owners still need to do a lot more in this space. Yeah. But I think it's getting much more difficult for an investment manager to get a mandate without having any capabilities around ESG factors.
I'm sure that is true, but I guess there is another question about, how well can the asset owners distinguish between the sort of the depth and the intensity of organisations' commitment to ESG? Because I think you're right, you can't get away with having nothing. Yeah. But there's clearly quite a lot of difference between different houses' engagement but it's quite difficult for the end user to actually distinguish between that. And I guess the subsequent question is, what's the role of the PRI in helping people to do that more effectively?
Yeah, so first, I think it's in the monitoring phase.
Yeah.
Well, first of all, I think if you embed it in contracts, that's great.
Yep.
Then it's in the monitoring phase and being clear about what you want and asking the questions and asking for evidence. What we do at the PRI is everyone who's a signatory to the PRI has to report on an annual basis about their activities. And then we have the ability, if you're an asset owner, if you want to get all of your managers' reports about what they've done, the PRI reports, you can get that information through a portal that we have, and you can compare them. I don't think it's the only thing that you should be able to use, but it is something that you can see. We also, as well as you reporting to us, the report that investment managers make is made public. But we also do an assessment. We give a score across asset classes. Those we don't make public, but more and more asset owners will ask for those scores from the managers. So that'll be a basics. They're also starting to ask more from the point of view of when they're looking for a new manager about using those scores as one of the things that they're using in their due diligence. Not the only ones, not the only thing. We're just doing a big revamp of our reporting system at the moment. It's sort of got big and unwieldy and things have changed over time, and we're trying to streamline it. But one of the things that we're also doing is making it harder. So if you get an A, you will be a leader. So we want to make it easier for asset owners to be able to see through the scores about who are the managers, who are the best at whatever it might be, whatever asset class that it might be. And we're revamping it at the moment. The new reporting framework will start in 2021.
And in making it harder, will there be people who stop being signatories to the PRI?
Possibly, but that's up to them.
Okay. But the bar will be raised, and if they don't clear it, you'll tell them that they need to go somewhere else.
So we brought in minimum standards 2 years ago. We gave people 2 years to make those standards. So after the next reporting cycle will be anyone who doesn't still make those minimum requirements will be delisted. Now, it's not we want everyone to be good at responsible investment and to be doing something. We don't ever expect everyone to be at the same level. So we've worked with those who don't meet those requirements. Some of them now do, but not all of them do. There's still there's about 140 that don't meet the requirements. They need to get up to speed, or they need to go. The minimum requirements aren't that high. So if you don't meet those, and then once we've done the first delisting, we're then going to review the minimum requirements, whether they need to be ratcheted up as well. So I think that's the really key thing for us is the reporting, transparency, ability to give an oversight.
Okay, we've got a selection of great questions, so thank you all very much indeed. And so what I'm going to do is sort of put three to you at roughly the same time, and then we've got about 10 minutes to work through them. Got a couple of questions along the same line of sort of what one policy would you like to see sort of brought in, and then there are a number of others that deal with or ask you for your view on divestment. So you talk about the challenges created by the climate lobby, but at the same time you're not a proponent of fossil fuel divestment. Not convinced that engagement is the form of dramatic pressure the investment community needs to put on fossil fuel companies, and could you comment on that? So why don't we start with those two while I scroll through the others?
Well, I might start with the divestment issue. I'm not against divestment at all, but I think it's a tool in the armament. I don't think it's the only tool. So if I use as an example, PRI is part of, and I'm on the governing body for Climate Action 100+. It's 365 investors representing 35 trillion in assets under management, and we are engaging with the 160 largest emitters in the world. And we're trying to get emissions reductions. We're trying to get them to report in line with the TCFD. And we're asking them questions about governance of their board. So what is the conversation is your board having about climate? Are they having them at all? Because some aren't, which is shocking and surprising when you're talking about the 160 largest emitters in the world. What we're trying to do here is bring about change. So if I divest, that doesn't necessarily mean I've got a seat at the table and I can bring about change. And we have brought about change. Maybe not fast enough, but through Climate Action 100 Plus, Shell has committed to emissions reductions, to thinking about Scope 3 emissions. It has linked its executive pay to sustainability issues and emissions reductions. We've seen similar things at BP. Glencore's agreed not to expand its coal. So these companies we're bringing about change. If we just divest for them, I could sell my share to you, and you might not care at all about these issues. So it is a balancing act. But I do think you have to get to a point when you say, okay, big energy company ABC, I've engaged, and now you're not making any change. And so now you obviously are a risk to my portfolio, and I need to divest from you, because I can be in other energy companies that are actually doing something. So I do think that there is a role for divestment, and there is a role for engagement.
Single policy?
Single policy, oh, that's hard. Single policy, I think, because I'm talking about climate a lot, I want to see a meaningful price on carbon. I think a meaningful price on carbon across the globe would mean that we would really deal with climate from an investment point of view much quicker than what we're doing.
How does that happen?
Well, it takes governments, takes government will. I mean, some governments have bought in carbon taxes. Are they at the right price? I'm not sure. Certainly from an investment perspective, we engage with the G20 and the G7 every year, and we say to them that as investors, we want a price on carbon. And if you bring one in, we will stand behind you as governments to support this move. And we continue to ask companies about how they're factoring in carbon, do they have an internal carbon price, etc. So that would be my one policy to make things move.
Okay, we've got another couple of sort of related questions. One of which is sort of very much about passive investing and what can we do to encourage the adoption of sustainable indices. And I guess one of the things I'd comment on there was the move by the London Stock Exchange had moved to do sort of renewables and non-renewables, and then reversed that. And so that there are clearly commercial pressures on exchanges and index providers that are difficult for them maybe to deal with. But related question that we've had a number of people make the same point is, how are you planning to raise traction in the US, given that this is the home of sort of a lot of passive fund managers?
I think it's a really big question. So first of all, I'd say that our view is that just because you're a passive investor does not mean that you can't be an active owner. In actual fact, you have to care a lot more about systemic issues and what's happening out there in the real world, because you're not diversifying yourself away from anything in any way. So that's certainly the focus that we have with passive funds. But then there's a number of pension funds, and I think this will continue, who are passive, but that doesn't mean you can't put some sort of ESG lens or screen around things. And I just think we're going to see more passive innovation that will happen, because people will say, well, I don't want this or I don't want that. And we'll just see. I just think we're going to see more innovation in that space and more pressure. Otherwise, it is a bit of a concern, because it's a continuing growing space.
It's difficult for them though, because they own the whole market essentially.
That's why I'm saying that you have to engage.
Yep.
You have to engage not just with the companies, but you have to be thinking much more about the systemic issues that face the world, and you should be engaging with policymakers. You should be engaging with regulators. You should be engaging with government, thinking about what's the best way to think about the market as a whole. And the market doesn't sit outside of the rest of the world. I think some people like to think of the market as something else, or the economy as something else, but we actually all live in societies, and the economy and the markets are part of that, not the other way around.
Which is going to be my
US comment.
Which is sort of, let's say, for instance, that there were 3 big index, sort of all passive fund providers, and you look at each other and think, well, hang on, do I need to do this? No, because the other 2 aren't necessarily doing it. So what's, in terms of game theory, is society the sort of the random that comes in to sort of say, actually, we're not prepared to let any of you ignore this any further?
Yep, I think that's it.
Okay.
I think, first of all, we need asset owners to get together, because none of them are big enough really on their own, or, a couple, maybe a few of them are, to come together to agree to tackle this issue with passive. On the passive side, we've done a paper on this issue. It's an area that we continue to focus on and put time and energy into.
Okay. One of the aspects that we feel has sort of impeded the development of responsible and sustainable investment has been the lack of comparable and available data. I think probably the last question, because I'm afraid we've only got a couple of minutes. But just where is the PRI in terms of working with others to enhance the data that this audience can work with?
So we also see this as a big problem. We made it part of our 10-year plan to how do we drive meaningful data. It's a big frustration. It's not that there isn't plenty of data, but how do you make sure that it's comparable data? So we've worked with a number of the corporate reporting organisations that have now formed the corporate reporting dialogue about this issue. We've done a paper. We did a paper with this with ICGM. We're bringing them all together about how do you get harmonisation. Unfortunately, this can mean that you might think that some of them don't need to exist anymore, and that means that the conversation is not always welcome, but we are having that conversation. But we think that it needs to go to another level. So we've had the TCFD, for example. We've had the task force of the industry for the industry. You'll have Mark Carney speaking this afternoon. It's one way that we've got really good forward-looking information about climate in a financial form that is starting. I think we need something similar to happen about ESG data. We need the industry to come together and force it to happen so that it's working for the industry, and that is certainly a focus that we've got, and we're going to continue to push on this issue.
Great, Fiona, thank you very much indeed, and I'd just like to sort of say thank you for the work that you do at PRI. I always find that if I'm looking for something or have an idea around ESG or sustainability, actually, what I normally find is that the PRI got there about 3 or 4 or 6 months before and have already a report on the thing that I thought was a new and interesting idea. And you do terrific convening work, bringing people together and really helping to drive this market forward. So if you're not already accustomed to going to the PRI website or going to PRI events, or you don't subscribe to receive emails from PRI, you really should, because it is a fantastic way to stay up to speed with what's happening, or in actual fact, what will be happening in around 6 months' time. So
and I think just on that, for the people in this room, we do have, the PRI, we work across ESG issues, but we also work across asset classes, and we do a lot of work about how do you integrate responsible investment, designed exactly for people like you. So I would really encourage you to utilise that information in the work that you're doing, because it's there, and again, it's really been done by the industry for the industry.
Yeah. Great. Please join me in thanking Fiona.